CPI is still strong at about 5%. Labor market also pretty robust. It's 25 in May, but is it one and done?
So I think we are getting to the point where the Fed has the option to actually hike one more time and pause. Now, whether it's one and done, that will depend on the data. But one thing very important to highlight here is what's the expected path for inflation? As you say, history doesn't necessarily repeat, but it does rhyme. So going back to the historical experiences that everybody can read through, premature cuts will actually be a challenge. And then, hence, I don't expect to see an aggressive cutting cycle from here. But there's certainly, we are at a level of rates where the Fed can actually pause after the next hike.
Well, some suggesting that when you take a look at yield curve from here, some form of normalization, however you interpret that, is likely to happen.
Well, it depends on every person's definition of normalization. We had more than 100 basis points of inversion in the 210s. We're less than half of that. Now, the bull steepening of the curve we saw, I would argue, if anything, has been driven by a lot of pricing of rate cuts in the front end of the curve. If anything, we probably see bear flattening from here, potentially as the economy slows down further and the market starts getting close to pricing the recession.
But Neeraj, okay, you look at the way the banks make money, right? You got these long-term assets, short-term liabilities. You know, that's always the conundrum here as well. And stresses within banks can actually really, of course, limit the amount they can make. But then you've got to, you know, to make things even worse for them, it doesn't matter if the yield curve inversion is half what it was, it's still hugely inverted. This is massively a problem. How much credit stress is there as a consequence of this? And is it fair to say that the banking turmoil we witness is not over with?
So first of all, very big difference compared to if you look at the 2008 crisis. Right now, a lot of the risk in the banking sector is driven by the interest rate risk. It's not the credit risk that we actually were experiencing back in 2008. Now, in terms
it's completely different. I mean,
it's completely different. There are pockets, just to be very clear, there are pockets. Commercial real estate, we are seeing some pressure. Levered loans, we're seeing some pressure. But it's not a broad-based credit issue. So what you have to watch from here is the profitability aspect as well as the provisions from the banking system. And we are right now in the middle of the earning results that are going to start coming in this week. So it's going to be important to watch what's the guidance, what's the provisioning, and where the profitability of the banking system is. But this is not a banking crisis per se. It's a little bit more around the money moving from deposits to money market funds, given the front-end yield curve and where the rates are.
Yeah, of course, it's more nuanced, sure. But let's face it, these banks are going to be making it much, much harder to actually let people have their money or lend money to these people. So, you know, you're going to see perhaps more expensive loans being given out than would be just, you know, a bigger margin in terms of how many basis points they're charging. That would have to be passed on to the consumer. That becomes inflationary. Then on top of that, if you're not getting small businesses and medium-sized businesses the same sort of credit facilities they had before, that's going to put stress on them, which can add to economic downturn. It's creating a perfect storm in some ways.
Not a perfect storm,
okay,
but
an imperfect storm.
Well, if you try to bring it all together, I would say the simplest way to actually summarize is slower growth, because that's the impact.
Well, that's what I'm saying, yeah.
Tightening of credit conditions, slowing down in terms of the credit growth, that's going to be leading to slower economic growth, some uptick in the default cycle in the specifically the levered part of the markets, and hence the risk premiums potentially will expand from here compared to where we are today. So if I take my view here, I think we are not looking cheap when you think about the credit spreads across the spectrum, but you do have a tilt towards quality given the uncertain macro environment.
So how do you play the bond market? What's looking attractive if you take into consideration what you have just said?
So overall, two parts. One, I still very much like front end of the curve and the investment grade credit. And the second is tilt towards quality. And that's somewhat a little bit more subjective because quality is not just defined by the ratings. Even within high yield, you want to stick with more quality, more predictable cash flows, because there will be corporates which obviously will easily weather the storm and get on the other side in a strong way. And hence, I think that combination of quality and front end of the curve in terms of yield gives you a reasonable level of carry in your portfolio.